Hello, welcome to Module 1 of Introduction to Business Finance. In this module, we're going to go over some of the foundational aspects of corporate and business finance. So without any further ado, let's jump right in. Okay, so let me just give you a very quick reminder of who's who and what's what. If you've gotten to the video, you've gotten pretty far, but just quick reminder. So the way that this is going to work is everything we do is in modules, as you know, and you've been through Welcome and Course Administration, and we're on to Finance Basics here. And we've got always going to have the information on the lectures there. And you always want to be following along with the item that's posted next. That's always going to be a PDF, and you can download that, or you can follow through here. I recommend downloading it and using a PDF annotator to fill in all of the information that is blank that we're going to encounter, stuff like this. Okay, that's it. I just wanted to make sure that everybody knew how to get to the information that we'll be using in these lectures, and the handouts for these lectures are in this file, CH01 Finance Basics 2 post.pdf. So that's it. Okay, I love finance and it's very exciting to me. So I want to start right away with an example that will hopefully impart to you why can be so exciting and hopefully maybe inspire some of you to feel excited by the subject. So we're going to look at an example involving healthcare properties. They have recently renamed themselves Health Peak, but we're going to go back in time a bit. So let's be true to the history and use Healthcare Properties, the name of the firm at the time we're going to be analyzing it. They are what's called a real estate investment trust, or REIT for short, and they're focused on healthcare. And what real estate investment trusts do is they acquire, build, manage various types of real estate. So for healthcare properties, they're focused on acquiring, leasing, managing healthcare real estate in particular. They're a pretty well-diversified company by geography. They operate in California, Illinois, Tennessee. They're headquartered in San Francisco. They're also pretty well diversified by market segment. They work in the medical office, hospital, and life sciences segments of the healthcare industry. So I want to take us back in time to the Great Recession, happened during 2008 and 2009. During this time, the stock market collapsed ultimately by about 50%. A huge amount of America was out of work, et cetera, et cetera. So in some ways similar to what happened to the economy during the COVID crisis, but in slightly different because the downturn in the stock market was much more prolonged, and the downturn in the economy is probably going to go for about the same amount of time in both cases. Okay, so we're going back in time to the Great Recession, and we're thinking as investors, and we're thinking, let's stop right there. Hello, welcome to Module 1 of Introduction to Business Finance. In this module, we're going to be looking at some of the very foundational basic aspects of business finance. So without any further ado, let's jump right in. I must confess, I love finance. I'm very excited about finance. So before we do anything else, I want to start with a simple example that hopefully illustrates how exciting finance can be and possibly inspire some of you to become excited by the subject yourselves. I want to, in particular, look at an example showing how we can use finance without much specialized knowledge to help us make smart investments. So let's get started here. We're going to be looking at healthcare properties, and we're going to be thinking like investors, and we're going to be asking, do we want to buy a bond of this company's that's offered in the bond marketplace? So by way of background, healthcare properties is a healthcare-focused real estate investment trust, or REIT for short, and their focus on acquiring, leasing, managing healthcare real estate. They're well diversified both geographically and by market segment. Geographically, they operate in California, Illinois, Tennessee, and they operate in the medical office, hospital, and life science segments of the healthcare industry. So I want to take us back in time to the Great Recession. The Great Recession happened during 2008 and 2009, and it's called the Great Recession because it was the greatest recession at the time since the Great Depression. And no one knew it at the time, but the middle of March 2009 was about the nadir of the Great Recession. Now, of course, nobody knew if things were going to continue to get worse or get better at that moment. But at that particular moment, let's think like investors and notice that there is a bond for sale in the bond marketplace of HCPs for $94.50. And by way of full disclosure, you should know that at the time I was managing money for clients at my firm, West End Advisors, and we were looking into whether or not we should buy this bond for our clients' accounts as well as our own internal company account. So that's the bond. The details of the bond were that it was going to mature in 6 months. And bonds are contracts. So maturity of a bond means that the contract is going to expire in 6 months. And the contract said at the end of the contract, when the bond matures, HCP must pay whoever is holding a bond at that time, $100 per bond, plus an interest payment of $2.80 a bond. So the deal would be for us and our clients, if we bought this bond, we'd pay $94.50 today. And in 6 months, assuming nothing untoward happened to HCP would pay us for each bond $100 per bond plus $2.80. And we want to know if this makes sense. So before we jump into this too much further with HCP, we have to make sure we understand what bonds are and how they work. So as I said, bonds are contract. They're in particular called fixed income contracts in finance. And in general, all that means is that the issuer of a bond issues bonds to get cash now when they issue the bonds. And in return, they agree to make contractually promised payments in the future. And you can see how this works in a simplified case for a 3-year bond. This is not HCP's bond here. This is just a simplified generic example. Okay. This is just to show you how things are working here. So if we have a bond issuer who wants to get $100 million to buy more property, expand a project, something like that, they could issue $100 million worth of bonds in agreement for contractually saying that they will pay $10 million in interest after a year, another $10 million in interest after 2 years, and after 3 years, another $10 million in interest, and then they'll pay whoever is holding the bonds back $100. Another important thing about bond contracts is that they're transferable contracts. And what that means is they may be bought and sold after they're issued in what we call secondary markets, but don't worry about that right now. And the key point is that the issuer of the bond is going to pay whoever is holding the bond at the time per the initial contract terms. So it doesn't matter how many times the bond has been bought and sold, doesn't matter who the holder is, and it doesn't matter at all what the marketplace price of the bond is. The bond issuer, no matter what happens to the price of this bond in a marketplace as time goes on, the bond issuer is contractually required to make the payments of the bond contract to whoever is holding the bond at the time. Okay, so with that in our pocket, let's jump back to our HCP example. So is this a good thing to buy for ourselves and our clients? Well, one way we could start to suss this out is to compare this bond to maybe the safest possible thing we could invest our money in. And in general, it's considered throughout finance that about the safest thing that anyone can do with their money is invest it in a US Treasury bond. That's not always true, but it's usually true. So let's go ahead and use that assumption. So what do? We go out and look in the bond marketplace for US Treasury bond that's going to be maturing on the same day as the HCP contract matures. So we go out and we find this. We would find this at Bloomberg, Yahoo Finance, Google Finance, something like that. And we'd find the market price today for this Treasury bond. This was true at the time in the middle of March 2009, about $100 a bond, and the contract for the Treasury bond, the contract written up by the US Treasury Department, said that in 6 months, on 9/15/09, they would pay to holders of each bond $100 plus 42 cents in interest. Okay, so a good way to look at what's going on is to make a table here of just the ratio of what we get to what we pay for the HCP bond, and then the safest possible investment we could make. So for example, for the Treasury bond, this is going to be 100.42 over 100, okay? And we'll come back to that in a second. Well, that's equal to 1.0042, okay? And for HCP, this is going to be, I have to go back and look because I have early onset Alzheimer's, just kidding, and I can't remember things very well. So I'm going to have to go back in real time, just like you would have to if you're following the notes later on. Okay, so it's 100 plus 280 and 94.50. Okay, so that's going to be 100 plus 280, and let's put that in parentheses here. Okay, and what we pay in this case is 94.5. Okay, and what do we get when we work that all out? 1.0878. So you do the math on that and you get let me get a point in there, 0878. Okay, so here's our comparison. So for the HCP bond in 6 months, we get almost a 9% return, okay, 8.8% in just 6 months. So if we annualize that, that's going to be close to 18% to the magic of compounding. And for the Treasury bond, so the T bond is giving us what? 0.42%. Not looking so good in 6 months. Okay, so clearly we're going to do much better with the HCP bond than we could be doing with the safest thing in the world. But we're not nearly done yet. That's just the tip of the iceberg. The first question you want to ask after you do that basic preliminary analysis is, what's the catch? And key thing to know about in finance. In finance, if something looks too good to be true, it probably is. Okay, if it just looks too good to be true, it probably is. So we want to be skeptical. We want to ask what's the catch here. So to do that, let's go back and think a little bit about what was happening in the Great Recession in March 2009. So in 2009, the S&P 500 which is a good broad measure of the United States stock market. That was down about 19% year to date, and in 2008 it fell almost 40%. So huge drop in the S&P 500. And what were folks saying about the situation of stock markets and the economy at the time? So for example, in the Journal Atlanta Constitution, they were saying things like the next shoe to drop will be the implosion of the commercial real estate market, and that means REITs are going to go down really bad. They were saying this in March of 2009, and there was a big REIT company called General Growth Properties, which owned things like South Street Seaport in New York, Faneuil Hall in Boston, the Inner Harbor in Baltimore, and it was generally understood that they were about to go bankrupt. So another black mark against REITs, okay? And the Wall Street Journal was saying retailers are about to begin a wave of bankruptcy filing, altering the landscape of malls and main streets across the country. And our erstwhile economist Paul Krugman was saying our largest banks are insolvent and must be nationalized. So generally, there was a lot of panic in the air, in particular, a lot of panic in the air about REITs. So that's our context, okay? But whenever something like that is going on, there's a lot of panic in the air. What do we want to do? We want to get out our phone. We want to go to our Headspace app. We want to be calm, and we want to do our own calm, independent assessment. Okay, so let's ask qualitatively, just qualitatively, no math involved here, what are the prospects for HCP's business, even if there's a terrible economy, even if the economy gets worse? Is the demand for its medical offices, hospitals, medical research labs going to collapse? And here's where I really wish we were in person, because it would be great to get various answers on this and discuss them. So I think it's clear to most people that the short answer is probably not, okay? The in-depth answer is a little more complicated than that. A lot of people may have lost their healthcare insurance, so they would be more reluctant to go to the doctor, don't go to hospitals unless they have to, things like that. But in general, the demand for healthcare and these services is not going to collapse in a recession. So in this case, we'd say that this industry is not well correlated to the macro economy. Okay, so it's a good thing to own in recessions. Okay, so now let's start looking at things quantitatively. So to do this, we're going to have to go back in time and use our knowledge of financial accounting and look at HCP's financial statements. Heads up, as Warren Buffett says, accounting is the language of finance, and that's true. And you are going to need to know your financial accounting for this course. Okay, all right, so let's start with checking HCP's balance sheet. And balance sheets, as a reminder, report on an entity's assets, which are cash and things it's using to generate cash, and its liabilities, which are just its obligations to pay cash in the future. And this is always done at a particular nanosecond in time, a particular snapshot in time. So here we have on the next page, HCP's balance sheet. The last one I could get when I was analyzing this company in mid-March of 2009, the last available balance sheet was December 31, 2008. So let's take a look at what we've got here. First, notice that in terms of assets, all I'm going to be interested in are the current assets. Why? Because the current assets are cash and assets that we can convert to cash within a year. Remember, our contract is just for 6 months. So if there are long-term assets, things that HCP is going to convert to cash far into the future, that's not going to help me. And same idea with current liabilities. Liabilities, remember, obligations to pay cash, and all I care about are HCP's liabilities, obligations to pay cash that come due within a year. So that's really all I need to look at on the balance sheet because we're going to be out of this contract after 6 months. So what do they got? So they have about 60 million in cash, almost 800 million in accounts receivable, almost a billion in notes receivable, and they have some other current assets. So notes receivable or accounts receivable, first of all, are just all the invoices the company has issued that hasn't been paid yet, just as a reminder. And notes receivable are similar, except instead of issuing invoices, in that case, they issue a 1, 2, 3, 4-page piece of paper called a note that looks like an invoice, but the folks getting this note have to sign it to agree formally that they're going to pay it. So it's a little more formal than account receivable. It may have some interest attached, and you do that for counterparties you're working with that have maybe a high probability of flaming out. So in case they do, you can go to the judge. You say, I don't just have an invoice, I have a signed note, so I need to be repaid, that type of thing. All right, so they have about 2 billion in cash and stuff they think they can convert to cash within a year. And on the liabilities side, accounts payable is just a stack of invoices the company has that they have not paid yet. So they've been issued and they haven't paid them. So they have about 300 million there in accounts payable. And they have a bunch of other current liabilities. That's a big number, and we probably want to look a little more into that. And here we have our bond maturing 9/15, which clearly is within a year, so that's a current liability. So you can see they have 102.8 million worth of those bonds that they've issued, and who knows who's holding them? They don't care as long as they send the money that's owed to the right people. Okay, so 2 billion in cash and stuff they think they convert to cash within a year. 800 million, a little bit less in obligations to pay cash within a year. So it's looking to me like they have a pretty good safety factor there to meet their bond obligation, or more specifically, they did as of this nanosecond in time, December 31, 2008. So that's helpful. But what if that was as of the end of 2008, now it's the middle of March. What if HCP is burning through cash at a terrific rate? The balance sheet won't help us with that. And it's an important thing to know because General Motors, before it went bankrupt, for example, in the fourth quarter of 2008, its operations were burning $5 billion in cash a quarter. That's just crazy. So that means for all the cars they made in the quarter, they lost $5 billion. That's pretty bad. That's one of the reasons they went bankrupt. They were just burning through so much cash. They ran out of cash. So how are we going to check on if they're burning through cash? We're going to look at the cash flow statement. So again, flashback to financial accounting, we need to know how to use these statements. Okay, so reminder, cash flow statement shows a company's cash inflows and outflows measured over a period of time. And we're going to look at the past 12 months. And it breaks down cash inflows and outflows into 3 buckets. Cash flow from operations, and that's the day-to-day business. Cash flow from investing, and this is cash flow from purchases and sales of property, plant, equipment, and long-term maintenance of that. For HCP, it's going to be mostly buildings, right? Because their business is they own these buildings and they rent out space in them to make money. So their PPE is their property, plant, and equipment, their long-term assets, are mostly buildings. And then the third bucket is cash flow from financing, and that's net cash to or from HCP's stakeholders. So, for example, that could be issuing stock to bring in cash, and then the stakeholders, they get additional stakeholders, which would be the shareholders of this new stock issuing bonds. Once they issue those contracts, the bondholders are stakeholders in the company, and when they repay bond principal, things like that. So let's take a look. So I have the cash flow statement for HCP. I've simplified this a little bit for the past year. So I have the total for the past year. That would be all of 2008 over here. And then I have it broken down by quarters. Quarter 1, 2008, quarter 2, quarter 3, quarter 4. And I have our 3 buckets here. So each row is a bucket. And one thing important to remember from financial accounting is that cash flow is, of course, a flow, so that the cash that flowed in from operations in Q1 plus what flowed in from Q2 plus what flowed in from Q3 plus what flowed in from Q4 is equal to the total for the year. Balance sheets do not work that way. Balance sheets are cumulative from nanosecond zero of the firm, but cash flow statements and income statements work like this. All right, so what do we got here? So their operations have been generating 130 million, 140 million, 180 million, 110 million, a lot of north of 100 million for the past 4 quarters. So through all of the Great Recession so far, for a total of about 560 million. So for investing activities, that's purchasing and selling buildings and long-term maintenance of their buildings, putting new roofs on buildings, repointing them, putting in new HVAC systems, stuff like that. See, it's clearly negative, and it's a fairly small amount. So you wouldn't know this yet, but this looks to me like it's pretty much just long-term maintenance of their buildings and stuff like that. New roof on this building, new HVAC system for that building. So you can see it's a lot less, okay? It's less than a fifth of what they're bringing in from operations. And financing activities, these are also negative. So this would be either paying dividends to shareholders, right? Giving money to the stakeholders, the equity stakeholders, or paying down principal on debt, bank loans, other bonds, things like that. But you can see here that that is also much less than what comes in from operations. And if we add everything up, their net change in cash has been, they're piling up cash, they've been piling up cash for the past 4 quarters to the tune of almost 300 million in the past year. So let's summarize. So the operations are generating cash, investments are negative, but very much less, okay? And in terms of financing activities, we're not sure exactly what it is, but it's also much less. So net is no evidence of big cash burn, and in fact, they are piling up cash. The firm is piling up cash. So that's pretty exciting. All right. So now let's look at everything we've done and think about this a little bit. Okay, so first of all, the healthcare industry is unlikely to collapse in the near future. That was our qualitative analysis. The balance sheet showed us that HCP currently, or at least as of 12/31/2008, had the capacity to meet the bond obligation way more than it needed. The cash flow statement showed that HCP has not been burning cash through the end of 2008, and it would sort of be amazing if all of a sudden that cash flow turned wildly negative in the first quarter of 2009. And so what do we conclude? We conclude here that the price of this bond was probably driven down by the generalized panic of the moment. And this is what's typically called in a situation like this. Hold on, here we go. Throwing out the baby with the bathwater. And what that stands for is everything just looks so bad, you just sell everything you've got, and you don't think about how it might be correlated or uncorrelated to what's going on, what its future prospects are. You just pick up that tub of water and you don't even notice there's a baby in it, and you throw it all out. So probably what we want to do for our customers and ourselves is buy the bond. But wait, there's a little bit more we have to do. In the real world, here are some other things we had to do before making a final decision. We wanted to check the news on HCP. There might have been some future event that could cause a massive cash bleed. For example, some of their facilities in California have their own well water. And in California, around this time, there were cases of PCBs being found in groundwater that was being used as well water. So if they discovered that, they might have a lot of lawsuits on their hands for a lot of existing and potential future cancer patients. So you want to check on something like that. That wouldn't be on the balance sheet yet. And you want to check on the notes to the financial statements. Remember we said those other current liabilities? We'd want to know why that was so big. And we'd also want to know what is in it. Okay, and to do that, we'd go to the sec.gov website where HCP and all publicly traded companies have to file quarterly financial reports, and they have to explain in that report what is in other current liabilities. So we looked that up, and I forget the details now, but there was nothing untoward in there. So epilogue, okay, what happened? We went ahead, we bought this bond for our clients and ourselves, and 6 months later, the bond did mature. HCP met all the obligations associated with the bond, and anyone who bought the same day we did realized an 8.8% return over 6 months, which is annualized even more really than an 18% return. And that's good, but not great. But the key thing about this that makes it great actually is that we realized this return with very little risk. And in finance, we're always going to be looking at risk and reward for any investment, potential investment we make, any financial project that we're considering. What's the upside potential? What's the probability of that upside potential? What's the downside potential? If we're wrong about our thesis, what's the probability of that? In this case, there was very little risk. Why? Because the return that we got, that 8.8% return in 6 months, that was contractually guaranteed unless what? And the only way that HCP could get out of that is by declaring bankruptcy. And they don't want to declare bankruptcy, and they would only declare bankruptcy if they ran out of cash. And as we saw, they were piling up cash. Our analysis showed very little probability of them going bankrupt, very little risk. So on a risk-reward adjusted basis, this was, I must say, an awesome investment. And yes, of course, it's true. I am telling you about my company's awesome investments and not our woofer loser investments, but I will get to some of those as we go on. Okay, at that point, let's take a little break and we'll go on with the rest of the module in a bit. See you soon.